Which leads us right into, let's go to page 361 again. I want to refresh your memory on the risk. All right? Right there at the very bottom, money in the bank, a checking account, a savings account, very low risk because it's insured. Even if that bank or credit union goes bankrupt, your money's insured up to a certain amount. And certificate of deposits, you're getting them through the banks and credit unions, so that money's insured if you go with those. U.S. government bonds, we're going to talk about those next, and that's considered the safest bonds possible when it comes to investing, is the U.S. government bonds. Even though they're not 100% safe, someday, you never know, our government could say, hey, we don't have enough money to pay, the bondholders or the bill holders. But at this point in time, it's considered the most safe. And when you get done saving your emergency fund, and now you're making decisions how to invest, you want to step into this safety investments first and work your way up to the risky ones, having the smallest percent of whatever money you have invested in the riskiest investments. And you've got to make sure that when you're thinking about investing real money, that you take the risk into consideration, because the more risk you take, the higher returns you should expect. If right now, CDs, which are at the lowest risk at a bank or credit union, if they're paying 1% for a 12-month commitment, hey, I want to buy a 12-month CD, here's $1,000. You're saying, here's my money for a year, and they're saying, thank you, we're going to pay you 1% for the year. So you'll get a 1% of $1,000, which is what, $10? And it's not a lot, but you're taking no risk. Basically, it's insured. But then as you step up and you look at municipal bonds, hey, Flint City is issuing bonds to raise money to change some of the water pipes. That's a little riskier than going into your bank or credit union and saying, I want to put money in a certificate of deposit. So you should expect more than 1% per year because you're taking on more risk. And this is what happens is people say, hey, I want to do some investing. I'm looking at certificate of deposits. I'm looking at municipal bonds. And they're both going to pay 1%. Well, if you're going to get 1% from either decision, pick the one with the least risk because you get the same return. Why not take less risk? So you've got to take risk into consideration when you're making decisions. Now I want to relate this to your retirement decisions at the company you're going to be working for someday, where they're sitting you down in human resources and they're saying, okay, where do you want your retirement money? You're going to have what's equivalent to a savings account at a bank is one of your choices. Usually it's called something money market fund. The word money market fund is almost always in part of the name of the safest investment being offered in your retirement selections at whatever company you're going to work for. Then the other ones have words in it like something that has to do with bonds and something that has to do with stocks. And you got to be able to look at this and say, okay, which ones are the riskiest and which ones are the less risky, and decide what percent of the money going into that retirement will be put into each investment. A lot of people will say, where are we at here? I want to go ahead and have some of my retirement money put in the really safe option called the money market fund. I want some of my money to go into a little more risk, but still fairly safe, maybe the bond mutual funds. And then they'll say, I want some of my money to go into the little more risk, like the stock mutual funds. And then usually there's one choice that's the riskiest of all of them. There'll probably be a word in there like growth, equities, or something like that are considered the riskiest of the options you're going to have when you select your retirement. And some people will say, I want a certain amount to go in there. So they'll put percentages. That's how almost every company does it. Say, here's 100% of the money going into your retirement. What percent do you want in each of these? And you might say, I want 40% to go into that money market fund to keep it safe. I want 30% to go into this bond mutual fund because it's a little more risky, but it's still safer than some of the others. What's left? I said, what did I say, 40% and 20%? Is that what I said, or 30%? So I'm at 70. I want 20% to go into this stock mutual fund, a little more risk. And then the last little 10%, I want in the riskiest part, just in case it takes off. I could make some really good returns. And that would kind of be the way you put percentages. And they got to add up to 100%. Then every payday, you'll see money being withheld out of your check, and it gets split up based on those percentages and put into those funds you selected. And that's how it works. But you got to understand which each of them, how much risk you're taking, so you can make sure. Because there's someone who doesn't know what they're doing. Will say, oh, it's just about 100% into that commodity mutual fund, the most risky commodities up at the top, speculative stocks, options, commodities. That commodity mutual fund is probably the absolute most riskiest choice within the mutual fund. And if you said 100%, it's that would be a pretty crazy decision. And it could look like it's paying off for you for about 10 years, and then all of a sudden you've lost 90% of everything you've been building up for 10 years because it's just that risky. It can disappear in as quick, 10 times quicker than it took you to even get the money to build up. And that's why you want to spread the money among different ones. It's called diversification, asset allocation. The story is you don't want all your eggs in one basket. That's the whole point. You want a balance. In case this happens or in case that happens, you have several forces working to cover something bad happening. This could turn out good over here because you went ahead and went with one, where the other one's turning out bad. You got something else turning out good at the same time to keep your portfolio from falling apart. Now,
what percent can the return, like,
what
can that range in from the commodities?
Before you have that meeting with Human Resources, you want to get a list of all the names, and you can look up at the task returns on the internet for every one of the mutual fund offerings that are on the list from your company. And I always do that. I want to see what has it done. When you look at past returns, when we get to 2 chapters from now, we're actually going to look at past returns from different mutual funds. And what you're seeing is it's average per year. So you can click on the last 5 years, and it will show you what it averaged per year for the last 5 years. Then you can say, what about the last 10 years? Well, that will include 2008 and 2009. So you'll say, oh, the average was so much lower when I go back 10 years. Well, because there was a crash involved in the average, What about the last 20 years? If the mutual fund's been there for 20 years, you can see how it's done per year for the last 20 years. And I do go back. And you can almost tell, by looking, the ones where you can get a chart, just like the Dow's chart on each individual mutual fund for a certain amount of time. The ones that are the riskiest mutual funds of the offerings will have ups and downs like this. The ones with the least amount of risk will be pretty steady, like you see at the beginning here.
Okay.
And that's kind of and then there's risk numbers and all kinds of things. Anybody not signed in? Has everybody got this? Okay. So that's where we're heading. So now, you've got your retirement going. You've got your emergency fund saved up. And you're ready to start investing, and your instincts are saying, let's buy some stocks, and that would be crazy. Take baby steps. And when I say take baby steps, now you're ready to start investing some of your savings. You just had children. You're saying, I need to put money aside for the college fund, and you're trying to plan ahead. Start at the pyramid towards the bottom and work your way up as you build up your investments. And don't start going to take a ton of risk at the top of this pyramid until you've already experienced the lower risks along the way. Get the experience. Which is why then that leads us to right here. This webpage. Many years ago when I started investing, this webpage did not exist. You had to go to a bank or a credit union or a brokerage to get United States government bonds and bills and notes. And now you can work directly with the government. They set up a webpage. You want to invest? Set up an account here, and here's all the things we have to offer. It's called treasurydirect.gov. And this would be a perfect place to start your investing experience after you have your emergency fund, after your retirement's starting to go good, and money's starting to get deposited into your retirement at wherever it is you work, and you got those things going, and you're finally gotten a couple of years have gone by, you got a couple of big raises, you're saving for a house, and you're saying, I want to make more than just 1% of my money in my savings account. This would be a great place to start. It's at the lowest risk and you can start experiencing investing out of your local bank or credit union. U.S. Treasury Direct, you would click down here where it says individuals. Whoops, hang on. And you can see all the options. Right here's the ones we're going to learn about: Treasury bills, Treasury notes, Treasury bonds. Now, this is why grandparents are not giving those savings bonds to kids anymore, because they don't know how to do this. You know, they're so used to just going to their local bank. Anybody ever get one of those kids? Is that still popular? So a lot of you have. And it says on there like $100 or $50. Well, your grandparent paid a lot less than that. That's what it's going to turn into at maturity, which if you got these when you're pretty young, let's say 14 or younger, I think the maturity, depending on which ones you got, are somewhere between 10 and 30 years later. So that's how they work. They're showing you what they'll turn into at maturity. So here's the ones we're going to talk about in this class: Treasury bills, Treasury notes, Treasury bonds. Bills have short maturities. Notes have medium length maturities. And bonds have long-term maturities, such as 30 years. Notes, 2 years, 5 years, 2 years, 3 years, 5 years, 7 years, 10 years. And Treasury bills, as little as just a few days up to 52 weeks. So that the names are based on how long the maturity is. Short maturities on bills. And right here on your PowerPoint, going to slide 13, it starts describing them right here. The bills could be 4 weeks, 13 weeks, 26 weeks, and we just saw all the way up to 52 weeks. $100 minimum. And what's nice about it, because you're investing with the government, no state tax. You still got to pay federal tax, but you don't have to report them on your state income tax. So in our case, that's an extra 4% in your pocket, because in the state of Michigan, our state tax is about 4.1, 4.2%, I think. I can't remember. Here's Treasury notes. $100 is the minimum. They're like 2, 3, 5, and 10 years typically. So they're a little longer amount of time. If you were looking at Treasury bills and Treasury notes, which one do you think would pay a higher amount of interest per year would be your guess? The notes or the bills? Think about, the risk is probably the same. You're betting on the U.S. government. But there's another factor involved that would make one, you should expect a higher return than the other. And that's time. When you're committing your money for a longer period of time, you should expect a higher return per year. When you're committing your money for only 4 weeks or 13 weeks, you're only going to get, don't forget, every time you see the percent they're paying, that's what it would pay if you had your money there a whole year. You have to then figure out, oh, I'm going to only have it there for 1 month. Okay, this is what it would make for a whole year, divided by 12, there's what it would make for a month. So almost everything we see, the interest rate is always advertised as a year, annual rate, no matter what the length of time the investment is. Since these is typically more than a year, like 2 years, you should expect a higher return. If those are paying, 0.75%, this one would probably pay a full 1% because you're committing your money for 2 years, not just 1 month. And so you expect a higher rate of return. Okay. This one also, you have federal tax, but no state tax. So you save like a little over 4%. Bonds. These are for 30 years. Now, should you expect a lower or higher rate of return than the notes and the bills?
Higher.
Because you're committing your money for so long, 30 years, that you should expect a higher rate of return. And yet the risk is the same. You're saying, I think the U.S. government's going to pay me my $100 back. Whoops, I'm sorry, we're going up there. My $100 back 30 years from now, because, what's the odds of the U.S. government going bankrupt? Pretty low right now, but the future you never know. Like I said, who would ever expect the city of Detroit to go bankrupt a few years ago? But it ended up being the largest municipality bankruptcy in our history, in the country. So it actually can happen.
So is like the country of Greece already bankrupt, or are they just like coasting on that
You know, I don't remember if they truly claimed bankruptcy, but they had such financial troubles a few years ago. I don't know, I remember that other countries were coming to bail them out type of thing through these special loans, but I don't know how that turned out.
It always seems like that we're just how that works go.
Yeah, they've been that way. There's the other, Venezuela's having financial troubles, the economic trouble. If the NAFTA doesn't, you know, if something happens with NAFTA, Mexico's gonna start having financial troubles. There's a lot of countries that are, you know, are gonna possibly have some financial troubles. You gonna have something?
Yes. He says, okay, so it's a treasury bond, you gave somebody $100, right?
Yeah.
And in 30 years, they give you back $100.
That's right, but you've earned, every 6 months, you get a check in the mail for whatever interest rate, half of the interest, yearly interest, every 6 months a check comes.
Okay, but is that going to cover the cost of inflation?
Some people have, it all depends. Like, if we were to look at what a 30-year bond pays right now, treasury bond, it might be at, I don't know what it's at, let's say it's at 3%. According to the CPI index, inflation's right now at about 2%, maybe 2.25, so you are beating inflation. But a lot of investors say, you know, I want to make sure I'm beating inflation in the future also, so they'll take some more risk and get higher rates of return than U.S. government bonds. For example, let's say you were going to say, I'm not going to do a U.S. government bond, I'm going to do a corporate bond. Hang on, you'll find it. So if you're, now, all corporate bonds are considered more risky than a United States government bond, because the United States government bond is backed by the U.S. government, so everybody so far has always gotten their money back. In history, all of our lives, and everybody's lives. But corporate bonds, you're taking a risk. There's many people who didn't get their money back on corporate bonds. If you own that bond when that company goes bankrupt, I told you last week the order in which they try to pay people back. Bonds are first, preferred shareholders, then common stock shareholders are last. Which, when the company goes bankrupt, usually the common shareholders get almost nothing. And the bondholders, you know, maybe 50 cents on a dollar, meaning 50% of their money, however many they own, possibly. I'm trying to think of Lehman Brothers was a finance company who had many bondholders. They had tons of bonds out there they've loaned, that they borrowed money from investors. And they ended up being the largest corporate bankruptcy in U.S. history in 2009. So there were a ton of common stockholders, preferred stockholders, and bondholders who lost a lot of money. And it literally took years for the bondholders to even get some of their money back, going through the court process. When the bankruptcy trustees stepped in, their job was to start selling everything that Lehman Brothers owned. Even paintings on the wall had to be sold. Office furniture had to be sold. They owned ski resorts as part of their investment packages, had to be sold. Everything. And that was the job of the trustees through the bankruptcy, was to gather as much money as they can. And they got their hands on billions, but before the bankruptcy, Lehman Brothers was worth many billions more. And so they got as much as they could, and then through the court process, started paying bondholders back a certain amount. And I don't think common shareholders got anything. If they did, it was because, hey, we got to take care of the bondholders first to a certain degree, then maybe some preferred stockholders, then maybe some crumbs could go to the common stockholders. But that's how much risk is being taken. You know, a lot of people didn't see it coming. They thought Lehman Brothers would be bailed out like a lot of the other ones, and it didn't. And they went bankrupt, largest in our history. Before that was a company called Enron. Has anybody ever heard of Enron, that bankruptcy? No one? That's how young you guys are. That was the largest bankruptcy in our history before Lehman Brothers, and a lot of people lost money, a lot of money. And then everybody knows General Motors went bankrupt, you know, 2009, 10, somewhere in there. And a lot of investors who said, oh, I'm not giving up on GM, I'm hanging on to that stock, got nothing for the stock.
What was the savings and loan crisis caused by?
I don't remember exactly what it's caused by, but that was a long time ago. We're going back to the 1980s, I think. Is that the one we're talking about?
Yeah, 83.
Yeah, so I can't remember exactly, but I believe it was a lot of loans that were made to under false pretenses of some kind. They all got into default, one like a domino effect, one after another after another. So I'd have to look that up. What you're looking at now are what are called bond ratings. So a company says, hey, I don't want to borrow this $3 million from a bank. I want to issue bonds and borrow the money from investors. They have to get the bonds rated. So they have to give all this information about their company, their financials and their history, so that an agency can rate them. And usually there's at least 3 that will rate the bond. If a company's bonds get a AAA rating, that's the agency is saying these bonds are the least risky of corporate bonds you can invest in. And as an investor, you expect a certain rate of return because there's still risk involved, but compared to a BAA bond, you're not going to make as much off of AAA because you're taking the least amount of risk. Where this BAA, you're taking a lot more risk, so you should expect a much higher return for it. Don't forget, the bonds all have face value on them. And I told you for this class, and in the real world, they're almost all what's called face value 1,000. Like when they're first sold to investors, they're $1,000. But, what was I going to say? And so the rate that they're being sold at the time they're first sold will be stated right on the bond. And for the life of the bond, it will pay that amount of money every year to whoever owns it. Because whoever has it can sell it to somebody else, and they can sell it to somebody else. So let's say this $1,000 bond, AAA bond, you got rated AAA, all right, and the company that's helping you figure out how to sell these bonds to investors, they say, AAA bonds right now with other companies are attracting investors because they're using maybe a 4% return rate called coupon rate or a rate of return. So that means if people buy these bonds, they would get $40 a year, right? And every 6 months, that would be $20 for every bond that you own. A $20 check will come in the mail. There you go, every 6 months, because that's what it is. But let's say you don't get a AAA rating, and you end up getting, let's just go with single A. So this is AAA, and this is just single A. Because you're taking more risk, the only way to attract investors when you're first issuing these bonds is you're going to have to give the investors more than 4%. You didn't get a AAA rating. That's what we're saying, what the company's hearing. If you want to attract the investors and you want to sell all $3 million in bonds so you can do this project that you were about to borrow the money from the bank for, you need to give them more than 4%. In fact, single A bonds right now, maybe this is what the company's being told, maybe they're paying more like 5%. So they would, if people buy these bonds who only have an A rating, they would get $50 a year. Divide by 2, that'd be $25 in the mail for each one. And sometimes investors go, hey, I want $25 every 6 months, not $20. I'm willing to take the risk of buying just a single A bond instead of a AAA corporate bond to get that extra money. Then you get to BA or below for a rating. There's they're considered what's called junk bonds. Now be careful. Some companies, out of your choices for retirement, one of the mutual funds may have the word in there, junk bonds, or something that's not so awful than the word junk. Another word that may mean trying to tell you this is a bond mutual fund, but the manager of this mutual fund is investing in higher risk type of bonds, which would be junk bonds. And what happens is while things are going well with these companies, they're paying a higher rate of return. Once you get into what's called the junk category, in order for investors to buy your bonds, if you're trying to raise money, you're not just going up like 1% like this. You're going up like 4%. That may be the only way to attract new money, is to be offering it at a much higher rate. Because as an investor, you're going, well, let's see, this is BA rating, so that's considered a junk bond. I better get a much higher rate of return, or I'm not going to buy that bond because I can get 4% up here at AAA, taking way less risk. Now, don't forget, U.S. government bonds, they're less risky than AAA. They're like almost no risk. They used to be called risk-free. Only until recent history are they not considered truly risk-free anymore. The U.S. government, for the first time in history a few years ago, got downgraded in their rating as something that could be invested in. So they're not considered truly absolutely risk-free, but they're so close to being risk-free, you might as well call it risk-free. So does everybody see how risk is taken into consideration? All right. So we got risk. Treasury bonds, we know how the different names are different lengths of time. We know you're going to pay federal tax, but no state tax on those federal bonds. And municipal bonds, there's no federal or state tax. Everybody hear that? Remember that calculation from last week? So now, you're thinking about buying bonds. You're thinking about a corporate bond. By the way, municipal bonds get ratings just like this. So you look at these ratings on municipal bonds, and those very last group of City of Detroit bonds were not AAA in any way. You know, they were already having problems when they were trying to raise more money on that last issuing of bonds. So people knew they were taking risks there towards the end. Here's what you got to watch out for. Where should I go with this? Convertible bonds. This is a different type of bond. We're going to slide 21. Sometimes bonds, in order to attract more investors, because they're worried maybe they won't sell all $3 million or whatever amount they're trying to raise, they may say, hey, we decided to make our bonds convertible in case someday maybe you're not happy with this bond and you want to sell it, you can convert it. And what this means is that if the bond is a convertible bond, there's certain little rules, but basically the investor could say, you know, I'd really like to sell this bond, I'd really like to get the money, but they have the option, instead of selling it, to convert it to stock. They can hand it into the company and say, you know what, I want to convert this bond, and they'll get a certain amount of stock in trade. But it's always predetermined as to how many shares. So let me find the example here. I wrote the page number down. 368. Here's a great example of how a convertible takes place. Kind of the middle of the page on 368. Just kind of highlighted it. So this convertible bond said, if you decide to take our bond and convert it to stock, you will get 34.6433 shares of the company's common stock. Now that's stated right on there. So that doesn't change. But the price of the stock changes every 10 minutes when the market's open, every 5 seconds actually. So the price is going up and down. So if you're thinking about converting, you got to kind of look at it and go, now if I wait a little bit, the price is on its way up. I could get more money because no matter when I turn this bond in to convert it, I'm going to get 34.6433 shares. And they're going, you know, if I sell this on the open market, I might only get $900 for it, but I paid $1,000. I'd lose $100. But what if I convert it? And they'll say, well, I paid $1,000. If I divide $1,000 by the shares, the number of shares I could get, that will tell me the target price that I could get my money back, the whole $1,000. If that stock hits $28.87, I can quickly say, I want to convert this, and you'd get enough shares at that price that would be like $1,000. And then you turn around and sell the shares, you got your whole $1,000. You don't have to sell it then for $900 at a discount. And that's the advantage of convertible bonds, is that you have options. Instead of just, oh, I need the money, I got to go sell my bonds. People aren't willing to pay me full price for the bonds. I'm going to have to take a loss on it. Something like that takes place. If it happens to be convertible, you can convert it then for common shares. You're looking at the price of the common shares, and you can see that you might come out ahead by converting it, then sell the common shares, and come out ahead. It kind of adds a little more safety. They consider convertible bonds are considered a little less risk because of that option. But most bonds are not convertible. And so you've got to take that into consideration when you get to the point of start investing real money beyond your emergency fund. You might look at bonds, and you've got to realize there are convertible bonds out there and take into consideration. Because you're going to be looking at so many bonds, you're going to be confused. You're going to go, wait, why is this one a AA paying a certain percent, and this one's AA and paying a lower percent? Why is this one paying a lower percent than that one? because this one's less risk because it's convertible, even though they're both AA, because this one's convertible, it's gonna pay a little less interest rate, a little less money each year, because it's a little less risk, because you have that option to convert it, based on the price of the common stock. Okay, one more thing about bonds that you kinda gotta watch out for or understand so you don't make a mistake, is called the call feature. Do I have it on there? Where is callable? Okay. There. Callable. I don't have it on my notes. I forgot what slide it's on. Hang on. There it is. Slide 22. All right. You ready? You invested in bonds for this company, and this bond was rated AAA. You're going less risk, and I'm going to earn a higher return than these U.S. government bonds. So I'm going for that bond. And you didn't realize it, but there's what's called a call feature on the bond. You're going, wow, I didn't even know call features existed. Usually, there's a certain amount of time that has to pass before the company can do this. But a lot of companies are going this direction where they'll put the call feature on the bond because they're going, hey, I'm issuing bonds because I don't want to borrow the money from the bank. So they issue bonds. But I'm putting a call feature. The company says, I'm putting a call feature on there because if interest rates go down, I don't want to have to pay this interest rate to the bondholder anymore. I want to be able to call the bond back in and reissue new bonds or borrow the money at the bank at a lower rate, and the company saves all kinds of interest that way because they have the option to call it in. And you got to watch out for that because when you go to buy a bond, you're going, here it is, I bought a bond. This bond's going to mature in 10 years. I got it for $850 and I'm going to turn it in for $1,000 in about 8 years from now. And I'm going to make that extra $150 plus the interest every year, not realizing there was a call feature on it. And and the call feature comes in and they say, okay, whoever has the bonds on this date, we're calling them in, and you have to hand the bond in and you get the face value $1,000 right then. I guess if you bought it for $850, that wouldn't be bad because you wanted to hang on to it to get the extra money anyway. But so that's how those work, is that all of a sudden you thought you were going to have a bond for maybe 8 years or 10 years, and then they call it, and you got to give that bond up. They have the option to cash it in right then and say, we're paying you off, here's $1,000. The bond's no longer paying any interest on that, but we're going to issue new bonds at a lower interest rate because those bonds were 6%, and now interest rates have gone down. We're going to issue new bonds at 4% because we're still rated AAA. And that's how they save thousands of dollars in interest.
So is there such thing as like a call bond that's convertible, and you could have a bond in stock market?
It could be both convertible and callable. It gives the company options, gives the investor options.
So even if you're doing well in the stock market, they could pull it out.
They could pull it out. They could say, I'm calling that bond. Usually there's a grace period at the start. Like a lot of them will say, we won't call this callable bond in the first 5 years. But after that, we could call it in anytime we want. And if interest rates go down, companies will start calling the bonds in saying, why pay 6% interest on these bonds if we can replace it? We can borrow the money from the bank now at 4%, get those bonds in, we'll borrow the money, pay the bondholders off. Now we pay the bank the same money that we owed on the bonds, but at a much lower rate, so the company saves thousands and thousands of dollars on interest by making that switch, calling them in at a higher rate. And callables, whenever companies think interest rates are going to go down in the future, they'll make the bonds callable. So they can call them in, and when interest rates go down, and finance that same money at a lower rate. That's the advantage of callable for the companies. All right, how are we doing here? Convertible asset allocation, diversification, spreading your investments over different mutual funds, different investments, so it's not all your eggs in one basket. Here we go. These three is where we're at right now, and this one right here, and this one right here, I want to make sure you understand these, because when you understand these two right here, you will then understand the whole concept. The golden rule that I try to tell everybody when it comes to bonds is that you want to be in bonds or bond mutual funds with your retirement if you think interest rates are going to be going down. That's the golden rule. If you think interest rates are going to be going down in our economy, you want to be in bonds. And here's why. You ready? let's say you own this bond right here, 5%. It's $1,000 face value. You got it at the beginning. It's at 5%. So $50 is being paid out every year, twice a year, so 25 and 25, right? About 3 years go by. And this happened 2009, 10, 11. Interest rates were sliding down fast. And now, the same rated bond, let's say, what did I say this was, A bonds, brand new ones, 3 years later, are being issued by companies. They're also A, but they're much lower rates because rates have gone down. So anybody buying a brand new bond is maybe only making 3.5% because interest rates went down. And so all they're getting is $35 per year. So you say, you know what? I bet you those investors who are looking at these A bonds, not AAA, AA, A, might be interested in buying my bond because mine's A, and it pays $50 instead of $35. Well, of course an investor would want to make $50 instead of $35. An investor wants to make $30 instead of $35 so badly that they'll pay you more than $1,000 for the bond. And that's called value appreciation. The value of your bonds went up, and if you hit it at the right time, when you think interest rates are at the lowest they could be, you can start selling all your bonds for over $1,000. $1,200, $1,300. Here's one for $1,500. It's because interest rates were going down, and you grabbed the bonds before interest rates went down. So everybody wants your bonds on the open market, and bidding takes place. And you're just going, wow, look at this, 1,100, 1,200. So you ready? You owned your bond. We're doing the same bond. And you were earning $50 every year. You bought it in 2007, 2008, 2009, 2010, 2011. And you're going, well, interest rates have got to be as low as they can go. Well, okay, 12. You hung on to it for another year. So now you've had it for, let's say, 6 years. Interest rates have gone down. And for somebody to get an A bond, they can only get $35 a year. So they're going, so you're thinking about selling yours because it's going to pay $50 a year. You put it on one of the markets, bidding starts. And finally it got sold. All right? And you sold it for $1,250. You made an extra $250 on it because you knew that after the market crash, that the economy is going to be stimulated by lower interest rates. And when the Federal Reserve lowers interest rates, the whole economy's rates start going down. Home loans start going down in interest rate. Car loans start going down in interest rate. And bonds go down in interest rate. And by that little piece of knowledge, because it's going to happen in all of your lives, it's going to happen again, you got to be ready and prepared for it. And you got to say, man, interest rates are up there, and they got to head back down eventually. I'm going to grab some bonds because I know they're going to be coming down, or right at the time the crash takes place, you start grabbing bonds because you know interest rates are going to have to go down. And you start selling them a few years later, 6 years later, at this extra money. Now let's think about this. You've made $50 every year, so you've been making 5% on it, but now you just made an extra $250. So let's add up all the money you made. $50 each year for 6 years is $300, is that correct? Plus another $250 is $550 divided by your initial investment. You bought the bond brand new for $1,000 when it first came out. So that equals, the calculator, that's 55%, 0.55, divided by, you had it for 6 years. Let's do this. Where's my calculators? Where's Alexa? 55 divided by 6. You bought a bond that was paying 5%, but because you knew interest rates are going down and you were able to sell it at a value appreciation, you actually made 9.17% on that investment. And an investment that you were only supposed to be making 5% on. You made really all that extra money got almost double the percent you made on that investment. And you took so much less risk than investing in the stock market. All because you remembered that golden rule that when interest rates are going to go down and you see it coming, grab a bunch of bonds and get ready to sell them in 5 or 6 years after interest rates go down and you think it's hitting bottom. Start selling because everybody wants your 5% or whatever percent you got in that bond. The bond's value appreciated, and this only happens when interest rates go down. And now, you're at your company. You've been there for a couple of years. And you've selected 2 or 3 or 4 different of those mutual funds that they offered you for your retirement. It's been building up. You got to remember this golden rule. A crash takes place. You know the economy is going to be stimulated by lower interest rates. So start shifting your retirement money into the bond mutual funds. Because if you could go back in time to 2009, 2010, 2011, those bond mutual funds were performing much better than the stock mutual funds. It was all because those bonds, the bond manager was selling bonds as they increased in value for extra money, and all of the people who were in that mutual fund, got to get all that extra money, and they outperformed. And so that's how you're taking the low risk and making the higher returns because you shifted into the right mutual funds at the right time just by remembering the golden rule. Bonds, when you know interest rates are going to be going down, is where you want the money to be, even when it comes to your retirement mutual fund choices. What's happening in our economy right now as far as interest rates, though? What's expected for the next few years? Up or down? Interest rates are heading up according to everything. So bonds would not be the place you'd want your money right now. And if you know interest rates are heading up, you go back to your retirement, you go to your webpage, and you shift the money out of the bond mutual funds. Because the bond mutual funds, if our interest rates do start going up like they're doing right now, car loans are going to be a little higher rate. Home loans are going to be a little higher interest rate. Overall rates are starting to head up a little bit. Those bond mutual funds in everybody's retirements are going to be performing awful. Because they can't sell them for appreciation. When interest rates go down, nobody wants my 5% bond. And I have to sell it for less than $1,000 to get rid of it. And that's why bond mutual funds don't do very well as interest rates are going up. And that shifting, that little bit of shifting, and it happens maybe once every 10 years there's a shift one way, and maybe a few years later shift the other way, and then you wait 10 years and it happens again. And if you can remember that, your retirement will outperform the other workers probably double in the 20 or 30 years. Just by making that one shift, those shifts into and out of the bonds at the right time. And it's so easy to predict. You just got to watch the news and start reading the headlines. They're all talking about how interest rates are heading up. And so you know, hey, I'm getting my retirement out of bond mutual funds. I'm going to the other ones. And then when you start hearing all the headlines saying interest rates are going to be heading down to stimulate the economy, hey, I'm getting into the bond mutual funds. And that shift will double your retirement in the 30 years compared to the coworker who doesn't touch it for the whole time. So that's what you've got to get out of this chapter, is the golden rule of bonds. Okay, that's bond value appreciation. Next, approximate market value. We're going to, wait, by the way, where are we here? 24. Here's a little more about the bond, dollar appreciation value of bonds. Selling the bond to someone else at a higher price. If the interest rate in the bond is higher than current interest rates, if interest rates go down while you own your bond will be at a higher rate than current rates for the same type of bond, for the same risk rating. Let's see. Now we're going to go, where's the approximate market value? We're going to page 370. You're thinking about buying a used bond, like a used car, where someone else got it right at first at $1,000, but now time's gone by and they're saying, I need the money. They're trying to sell it on the open market. This is how you can kind of see what it should be priced at. Gives you a good idea if they're asking or what your bid might be to make sure you're not overbidding or anything like that. If you're going to buy a used bond, you're going to buy it not for $1,000, but somewhere either below or above, depending on the rate of the bond and the risk. how to calculate what that bond's price should be approximately is always what does it pay per year in interest, because they're all fixed. That 4% bond pays $40. That 5% bond pays $50. That 3.5% bond pays $35. That's fixed for the life of the bond. So it's whatever interest rate it's going to pay divided by what current interest rates are for bonds just like it that are coming out brand new. So this bond, this person's been hanging on to it. It's been a 4% bond, so it's been paying $40 every year. But interest rates went up during the time they held it. And they're saying, I need this money, I got to sell it. But interest rates went up, so who wants a 4% bond when the exact same type of bond with the same risk now are paying $50? They're 5%. You take what your bond pays, $40, divided by current interest rate of bonds just like it, which are now paying $50, which is 5%. You will most likely only get $800 for your bond because interest rates went up. You held your bond while interest rates are going up, and it's not worth $1,000 anymore because people could buy the exact same risk level of bond and get 5% instead of the 4% yours pays. So you have to sell it at a discount, and this is how it's calculated. You ready? I want to do another one. You own a bond. Let's do this one right here. You own this bond. It's been paying $50 every year. And now time's gone by, it's a 30-year bond, but you can't hang on to it till all 30 years. You've got to sell in the open market. Bonds rated at this exact rating, just coming out brand new, are now paying, they're now paying 4%. Instead of interest rates going up 1%, interest rates went down 1% while you held your bond. So you're going, what could my bond be worth? Well, how much is it paying per year at 5%? $50. And what are bonds going for now that are just like that bond, brand new ones? Only 4%. Take $50 divided by 4%, and this is approximately what you could sell your bond for. 50 divided by, I'm going to turn 4% into a decimal point, 0.04. Look at this. I can sell my bond for $1,250 because interest rates went down. And that gives you a good idea of what investors, now it's not going to be exactly, whoops, you can't even see this. It's not going to be exactly $1,250, but this gives you a good idea of what it could be worth approximately. Even if you only sell it for $1,225 because a new investor wants to make that a little extra because they could go buy a brand new one and make 4%, or you got to give them a little edge, you're still going to make extra money because you bought it when they were issued at 5%. Bonds just like it, same risk, are now at 4%. They'll only pay $40. People want your $50 bond. So it's the amount the bond pays in interest divided by the current rate for the same risk of that bond in the open market. Interest rate went down, divide the 4% into the $50. You can see what kind of premium you could possibly get for that bond. That's called the approximate market value. And there's for sure a question on your quiz on this approximate market value in your future. For sure. That's one. This bond value appreciation, this approximate market value, these are some of the most important parts of today's lecture, so you understand how these bonds work.
Will you very clearly lay out which one is the current interest rate and
Yep.
what you're currently getting back?
Yeah, the little story would be just like the example, kind of. Here, let's go to the back of the chapter. There's a problem probably back here. I have already posted some study questions, problems, and answers. And there is one for approximate market value. There's another one for value appreciation. And there's, let's see here. Let me find one here. Oh, here's problems over here. Right on this, right here, I'm trying to find one, purchase, right here, General Electric, 4%. Okay, here we go, top of the page. 5 years ago, you purchased a $1,000 corporate bond issued by General Electric. The interest rate for that bond is 4%, but today's comparable bonds are paying 5%. Interest rates went up. If you want to sell your bond, the approximate dollar price of your bond would be what? Higher or lower? Let me rephrase this. I want to make sure everybody gets this. You've owned this General Electric bond for 5 years. What amount is it paying at 4%? How much are you getting each year on that bond? 4%. $40. $20 every 6 months on that bond, right? All right. You got to sell it before maturity. But bonds just like it are going at 5% now. Somebody went to buy a bond of the same risk rating, they could get $50. So why would they want your $40 bond? So do you have to sell it for more or less than the $1,000 you paid for it, most likely? That's right. How do we figure out the approximate market value is, how much is the bond you're about to sell at 4% paying per year? How much? 4%. $40 divided by what are bonds selling for brand new in the open market now? 5%, 0.05, and you'll have how much you should approximately how much your bond will sell for because you need to get rid of it and interest rates went up. What's the number for me? 40 divided by 0.05. Somebody give me the number. I'm going to guess 800?
Yeah.
$800. All right? That's exactly how it will be written on your quiz. And there are study problems with answers just like this already posted on Blackboard. Do we get this?
Yeah.
Now, all of this seems like a lot of stuff. But what I'm trying to get across to you is when you finally say, hey, I'm ready to do some real investing, the stock market's not your only option. And the stock market is your riskiest option. And there's a lot of other options out there where you can make good returns on the money if you understand how bonds work. And there's far less risk in investing in bonds compared to stocks. And if you understand how the economy's interest rates affect these bonds, you can take advantage of it with that piece of knowledge. Just be patient, and you'll know that there's times coming, hey, interest rates are going to be going up. I better get rid of these bonds or get out of my bond mutual fund. Hey, another 8 years go by, hey, interest rates are going down. This economy's into a recession. It needs to recover, so interest rates are going to be heading down. I better start getting into bonds right now before this recession starts or before interest rates start going down to stimulate it. You will come out, you will make some great returns, the kind of returns people chase in the stock market with far less risk. That's the point of bond investing. It's far less risk, and yet you can still get some good returns if you understand timing. And timing is easy with bonds because interest rates go up and down slow. They're always slower than what's happening. They're reacting to our economy. And when our economy goes into recessions, interest rates start to go down, but it takes a good 2 or 3 years before they hit bottom. Even though our economy had a big pitfall, it's not till you could grab some bonds right then, interest rates are going down for 2 to 3 years, sell the bonds, make some really good money off them, and have the kind of returns you're chasing in the stock market with way less risk. Way less risk. That's the point of bond investment. Okay? That's it, except for bond price. Some of you are going to start searching for bond markets. You'll start seeing, hey, all these bonds listed, and you're trying to figure out what price is the asking price for these bonds, because all you see are numbers like this. 112, 92, 88, 121. And you go, what do these numbers mean? I can't figure out what the price is. These numbers on bond prices, this is how they do it, is the percent of face value that they're asking. So all the face values are 1,000. So that would be $1,210, 121. 121% of 1,000. This 92 is 92% of 1,000, so $920. You just basically add, you can figure out the price once you get this down. 112, what would be the price of this bond? 1,000 what? 120, just put a 0 on the end, there you go. This is the 112% of face value, which is 1,000, 112% of 1,000. I said 88, how much is that bond? $880 is the asking price of the bond, 88% of face value. So bond prices, in the old days, I always had to look in newspapers. This is like the internet now, wow. But they still use numbers like this. You won't see like buying a car. This car is $10,300. No, they all use code, because they can't get away from it for some reason. You know, they can't get to normalness. 1,210, 1,120, $920, $880. But you'll just see numbers. You won't see it actually as dollars. The asking price for this bond is $132. What is the asking price? $1,320. There you go, 132% of face value. Okay, everybody signed in. You're preparing for a quiz. I suggest you print those study question problems and have them with you while you're taking the quiz. I'll see you in 2 days.